The Australian economy just grew again. So why is everyone you know quietly getting poorer? Today, the Australian Bureau of Statistics dropped the March quarter numbers. GDP up 0.3%. The government will obviously celebrate it, and the headlines will say the economy is expanding. But there's a second number on that release. A number they won't be putting in any press release for obvious reasons. GDP per person fell again. And that's the fifth quarter in a row it's gone backwards. The longest per capita recession in the 65-year history of this data. Both of those things are true at the same time. And once you understand how, you'll never look at GDP headline the same way again. Today, I'll walk you through the number they're hiding, the housing squeeze proving it's real, the data center mirage propping up the whole thing, and where this leaves a trapped central bank. So hit the like button, subscribe to the channel, and if you want the full framework on the 18-year cycle, the 3-part mini course is linked in the top of the video description. It's all completely free, no excuses, go get it now. So let's get straight into the data. The headline first, GDP grew 0.3% in the March quarter. That missed the 0.5% the economists were tipping. And here's the nasty part. Last quarter, December, the economy grew 0.9%. This quarter, 0.3. So growth didn't just slow, it got chopped down by 2/3 in 3 months. Annual growth came in at 2.5%. That's the weakest read outside the pandemic since the early 90s. Remember that recession we had to have here? But the headline isn't the story. The story is per capita. GDP per capita just means total output divided by the number of people. So we're getting a whole lot more people, they're producing a whole lot less. It's your slice of the economic pie, and it fell by 0.1%, 5 quarters in a row now. The chief economist at Challenger, Jonathan Kearns, confirmed this is the longest stretch on record since they started tracking it. So how can the total grow while every slice shrinks? Australia hit 28 million people on June 2nd. It was literally the day before yesterday, 2 days before the GDP release. The population is growing at about 1.6% a year. Net overseas migration drove 73% of that growth. People got to start having more babies, huh? And the government just upgraded its migration forecast to 295,000 for this year alone. So do the maths on that, and a new resident arrives roughly every 60 to 75 seconds. You can see where this is going, right? When you add that many consumers, you add spending, you add total activity. The top line number goes up, but here's the trap. The population is growing faster than the economy is. More people in the room, same size pie, smaller slices for everyone. I don't like the sound of that. The growth isn't anyone getting richer. It's just more mouths to feed. And we definitely know that experience when it comes to the NDIS here. And yeah, you might say everything gets smaller if you divide it by a bigger number, obviously. But listen to this. Output per hour worked fell 0.6% this quarter. That's productivity. That has nothing to do with population. It means each Australian worker is producing less per hour than they were. And at the same time, unit labor costs rose 0.5%. What does this mean? We're paying people more per hour and getting less out of each hour. Kearns called this the heart of the weak growth. His words were that businesses and workers just aren't getting more efficient. Until they do, we stay stuck in a low growth funk. So that is not the statistical illusion. The economy is genuinely going backwards on a per person basis. That's the data. But numbers on a screen are abstract. So let me show you where this exact mechanism plays out in real life, where it actually hurts. Unfortunately, housing. Because the housing story is the per capita story wearing a different costume. Too many people, not enough homes, the average person gets crushed in the gap. We've seen that before, prices rising. Let's start with what just broke. Residential construction work fell 0.6% in the March quarter. That's the first quarterly decline since June last year. Now I want to be precise here because precision matters to us on this channel. Total construction actually rose. That's the data centers and commercial work, and we'll get to those in a minute. But the homes Australians actually live in, that's the bit that's now going backwards. And the businesses building those homes are dropping like flies. Roughly 3 construction companies are collapsing every single week in 2026. Construction is now the single biggest sector for corporate failures. Around a quarter to 27% of all company insolvencies in this country. Why? 3 reasons stacked on top of each other. Fixed price contracts signed back in the boom that are now underwater on costs. The tax office resuming aggressive debt enforcement after years of going easy, and a 4.35% cash rate strangling project finance. This is not background noise. This is the people who are supposed to build the homes going bankrupt trying to. There's just too much red tape going on. And the shortfall it creates ties straight back to the migration story. The National Housing Accord set a target. In 22 months of operation, it has never once hit its monthly target, not a single month. The cumulative shortfall is now approaching 83,000 homes and growing. To catch up, Australia needs to build around 260,000 homes a year. It's nowhere near that, but we've heard all of this before. So you've got a record population growth on one side and home building actually falling on the other. Tell me how that ends for the average renter. It ends exactly where it is right now. Rents are up 5.9% over the year. Vacancy rate sitting at around 1.2 to 1.5%. And if you're currently looking for an apartment in one of the major urban centres, you know the prices of these things. A healthy, balanced market has a vacancy rate of about 2 to 2.5%. So we're running at roughly half the normal breathing room it takes for a normal market. The typical renter is now handing over about a third of their pre-tax income just to keep a roof over their head. So that's more like 40% after tax. And the labour market that's supposed to bail people out, it's softening too. Unemployment ticked up to 4.5% in April from 4.3%, the highest since November 2021. The economy shed 18,600 jobs in a single month. Youth unemployment jumped to 11.1%. So the squeeze isn't theoretical. It's the rent, the mortgage, the job, the lot. But here's where it gets really interesting, because that thin little 0.3% of growth they're celebrating, it's barely even real. Let me show you the Mirage holding it up. The one thing carrying the GDP print is a surge in machinery investment. It jumped 16.3% in the quarter, the biggest single quarter jump in 30 years. Sounds incredible, right? Australian business booming, investing in the future. That's what they tell us. Except look at what the money actually bought. 8.7 billion of it went into data centers in 3 months. It's a 96% jump on the previous quarter. So if you're invested in AI, great stuff. If you want to get a house, another question. This is the global AI hype landing on Australian shores. And here's the problem. Those servers, those chips, the hardware, it's almost all imported. So it doesn't build a domestic industry. It just adds to the import bill. And the import bill did something Australia hasn't seen since 2017. It produced a trade deficit. The trade balance swung from a 1 billion surplus to a 2.4 billion deficit in a single quarter. I'm even finding that hard to believe. Net trade subtracted 0.8 percentage points from growth. All right, let's simplify these things. The headline grew 0.3% and the import surge from the very thing propping it up dragged it down by 0.8. So you import $1 billion server farm. It adds to the investment column. It subtracts from the trade column. Net effect on your actual life, roughly zero. The one green number the government is waving around is essentially an accounting wash. This is what economist Greg Jericho meant when he called these GDP figures meaningless. Propped up by capital-intensive projects that don't create jobs and don't lift living standards, while household income per person keeps sliding. And Paul Bloxham at HSBC went further. He said the data is already dated, that the more timely signals point to a sharp weakening and that the economy is likely already in a downturn. This is the headline substitution game the cycle plays every single time. The convincer story changes, the behavior does not. In 2021, it was the everything bubble. Might have heard that on my channel. In 2026, it was the AI productivity miracle dressed up as an engineered soft landing. Obviously, different costume this time. Same dumb money chasing the same hype, inflating the same official numbers. Now, none of this makes sense in isolation. It only clicks when you place it inside the bigger framework. And that's exactly what the free 3-part mini course is built to do. Part 1 walks you through the 18-year cycle and the 220 years of data behind it. Part 2 shows you exactly where we sit in that cycle right now. And Part 3 is how we position for what comes next. It's completely free and the link, you guessed it's in the top of the video description. So now I want to hear from you. After everything we just walked through, where does this resolve? How many more quarters of falling per capita output before these crooks admit what the data already shows? Drop your call in the comment section. I'll be reading every single one of them and replying to as many as I can. So hit the like button, subscribe to the channel, and grab your free 18-year cycle mini course in the top of the video description. I'll see you guys at the next video or on my other channel looking at the stock markets, commodities, Bitcoin, and the real estate cycle. Until then, take care and peace out.